Thank you very much, Mr. Schultz, for your time here on All Angles. Now, should we expect the interest rates to go up, and by how much, really?
Yes, good afternoon. I mean, we are anticipating a 25 basis point rate hike out of the South African Reserve Bank this afternoon. I think a lot of it is really premised on one, I think, tighter global financial conditions. We've seen the US Federal Reserve already raise interest rates this year. But also, I think more importantly, we've got a higher inflation trajectory globally, but also in South Africa from higher oil prices, higher food prices. And that probably will prompt the Reserve Bank to act this afternoon.
All right. So, Mr. Schultz, I saw that some economists are saying that this would be for the good because we're going with the trend of what's going on across the world. But South Africa is one of those economies that really has been struggling. So this will obviously still be very bad news for those who need to pay for their homes and vehicles.
Indeed. Look, I think any interest rate decision in the current context of our economy, which is still struggling. I mean, we're yet to get back to GDP levels of activity that we had before the pandemic. And so what this highlights is that, this is a decision that won't be taken lightly by the South African Reserve Bank. But at the same time, it's probably a necessary evil in order to help curb inflation expectations and obviously help ensure that our interest rate differentials with that of the rest of the world remain intact. And so, unfortunately, what this means for the South African consumer is that it means higher interest rates, it means lower disposable incomes, and that is going to place further pressure on this economy, unfortunately.
And, the viewers who are watching right now are probably thinking, well, she only asked about people who need to pay bonds and for vehicles. So if you don't have a bond or a vehicle, it doesn't mean anything for you. But that's not true, right? It trickles down even to the poorest of the poor.
Absolutely. I think when it comes to tighter interest rates, this has an impact on the way corporates operate, on the way business operates. It decreases demand in the economy, and ultimately that has some feed through into levels of employment creation. So it's a tough one, but as I say, I think probably necessary in the context of really nipping inflation and inflation expectations in the bud and ensuring that we keep an interest rate differential in the economy that isn't out of kilter with our peers. And that's really important because it helps cushion the currency. If the rand weakens significantly, that also has implications for the poor. It has implications for higher inflation, and that ultimately also impacts on the poorest of the poor in this economy.
So obviously a higher interest rate means it's more expensive to borrow money. So there's something positive there, right? Because if I know that it'll be more expensive for me to borrow money, I'd rather stay away from borrowing the money and maybe just postpone getting that expensive item a little while longer, and I'll spend less.
Look, I think that's exactly kind of the thinking here, is that higher interest rates should deter the consumer from going out and taking that additional loan or continuing to spend aggressively on their credit card, because at the end of the day, higher interest rates means that if you are spending a lot more on credit or utilizing a lot more credit, that's ultimately going to cost you more at the end of the month. So from that perspective, I think the message is loud and clear. Tighten belts in an environment where interest rates are going to rise globally.
Well, thank you very much for your time here on All Angles. Jeff Schultz, Senior Economist at BNP Paribas South Africa.